And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It is often said that software has eaten the world, but it isn't the only investable asset. Some are arguing that hard assets like real estate and infrastructure are an important diversifier away from technology. Let's talk with Dan Foley, CBRE Investment Management Portfolio Manager for the newly launched IQ CBRE Real Assets ETF. I know that's a mouthful, folks. I'm going to explain it. Don't worry. It's an actively managed equity strategy that invests in companies tied to real estate, to real assets, infrastructure, and real estate. Also joining us, my old friend Tom Lydon, VettaFi Vice Chairman. So, Dan, you launched this new ETF a month ago in the midst of a tech frenzy.
Yep.
Not great timing, but you did it. You say inflation makes hard assets a great investment. Can you make the case why now? Why hard assets?
Yeah, look, we think investors are coming to the asset class to have inflation protection. We're seeing large institutions globally enter this space. We think retail investors should be too. We think that the ETF market is lacking options in this space. And frankly, we just think there's a lot of opportunity here with secular changes in things like digital transformation, decarbonization, and then just frankly mispricing in the market. So the opportunity set offers a robust double-digit return potential, in our opinion.
Does this track here? We're showing this now. This is brand new, so it's got a month of history. But does
Sure.
You back tested it? Does this track things? Does it track REITs? Does it track commodities? Is there anything? What are you following?
Sure. So at CBRE Investment Management, we have a history that goes back in the REIT space back into the mid-1980s. We've been live with infrastructure strategies for over a decade, so we have quite a bit of history here, and of course an investment management platform that is nearly $150 billion in scale, operating within this real asset space. So we have a lot of history here, a lot of expertise and boots on the ground. We think this is important for investors. And we do think that over time, this has been one of the most attractively positioned segments of the real asset universe. And we think there are a number of opportunities that make that true in the go forward as well.
So we've seen higher interest rates in the last week. It seems to be impacting real estate. REITs have had a rougher time this week. They're underperformers. We had Nassim Taleb on, the author of The Black Swan. He was on this morning on Squawk Box. He said, be careful about real estate, because it can be unstable due to the higher rates. Does it concern you? Or are you in a different kind of space than he's talking about, the generic real estate space?
Yeah, look, one, I think valuations are very compelling. So I would take the other side of that and look at the opportunity on the other side, right? History has told us that when you get parts of the real assets universe, like real estate trading at 20% discounts, the go forward provides 15 to 20% returns. That's a history lesson, but we think the elements are in place for a pretty strong total return going forward. And within the infrastructure space, you have a very different dynamic of very stable assets, right? You turn on the lights in the morning, you brush your teeth with the water, you get on an airplane or you ride the train like I did this morning. These assets have a very different cash flow, stable cash flow profile. And they're also the assets that are enabling a digital economy, data centers, cell towers, right? Enabling decarbonization, right? You need these leading infrastructure companies to make that investment, and it's driving growth that we think will drive a differentiated outcome.
I want to get to what's in this fund, but Tom, I want to get you in here. Your thoughts on the hard assets. We've heard this play before here. Is there a case now for owning them, or owning them still, or continuing to own?
Well, in the last couple of years, Bob, as you know, as the market's been challenged, 1/3 of advisors have had 10 to 20% of their allocation in alternatives in some of these areas. Obviously, energy was a great performer. It's come back down and settled. But if you look at REITs, for example, office buildings, retail, somewhat challenged. But also there's some other areas, and that's why I like this is actively managed. If you have areas like healthcare or data centers or areas like residential, which is in demand right now. You can kind of pick your spots, is that right?
Yeah, well, look, if you think about, I think it's a bit of a misnomer when you read the headlines, what is the REIT sector, right? Yeah. The REIT sector today is a lot different from the REIT sector prior to the global financial crisis, right? Nearly 60% of the investment universe are what we call next generation type real estate assets, right? Where the private equity players, where new allocations are coming in, that's things like self-storage, some of the areas that you mentioned, things like single family for rent, right? The cash flow growth and outlook trajectory of these entities, very different. But they've all suffered with the REIT sector in a rate environment. So we think the valuation dynamic today is incredibly compelling.
You know, Tom, there are other hard asset ETFs that are out there. We've covered them here. Van Eck, our old friend, Jan,
Yep.
he has got a natural resources ETF that holds basic materials with an emphasis on energy. That's out there. There's Flex Shares. They have a global upstream natural resources index, another one I can't pronounce, Gunner, right, G-U-N-R.
Yeah.
They have water and timber. Look, here's a little list here. Along with positions in companies in energy productions and metals extraction and agriculture. And then there's the old stalwart. There's the Vanguard Real Estate Fund. It's REITs. So there are other choices out there, Tom.
There are, Bob. And in ETFs, there are tons of choices. The whole idea is you got to lift up the hood and see what's inside. I mean, areas like Gunner and Van Eck's were very heavy on energy. So they did really well in the last couple of years. Recently, that's come down a little bit. So that's important to see. But areas like agriculture, where you can kind of pick your spots, base metals, there are ETFs out there that represent all those areas. So you can be very, very selective. But the idea is if you're going to have an overarching hard asset, yet need to understand, A, is the manager have a fixed index, or is there going to be an active strategy, and they've got a history of being doing a good job
as
far as
this is an active strategy. Right. But this is a differentiator, though. When you mentioned energy, commodities, essentially, that's what's not here, though. So I see infrastructure companies. Let's put up what we've got in some of this. I see infrastructure companies like Crown Castle, and those who don't know, they do cell phone towers and fiber optics. I see real estate companies here like Public Storage. We all know them. They do storage. Then we have utilities. There's NextEra, I see there. WC Energy is a utility company. Equinix, we had the CEO on this morning. That's huge in data centers. Sun Communities is also there. They do manufactured housing.
That's right.
I guess. What I don't see here is commodities. I don't see Freeport McMoRan. I mean, it's a copper. They're produced as a hard asset. I don't see oil stocks. Explain why commodities are left out of what would think of the natural hard asset as would be commodities.
I think when we approached the marketplace and we kind of looked at the landscape, what's out there, what can investors get? There was a very wide field of real assets. And not only what are they investing in, right? What segments of the universe are they investing in, but in what flavor. Are they equities? Are they debt? Are they a mix? How are they making these allocations? And frankly, if you do the historical analysis, the risks and returns are so-so, right? And so we think that the opportunity, again, is more focused in these areas that have secular trends, like I mentioned earlier, with digital transformation. Equinix is a great example of a world-leading entity. Just had a great investor day yesterday, 7 to 10% growth, growing the dividend 10%. You know, that's the kind of assets you want. These are essential to the new economy, right? And you can get that, we believe, at a discount. So we believe that, you know, focusing on the areas of real assets that we are focused on provide more opportunity and a differentiated view from what's in the marketplace today.
So do you think, I guess, Tom, where I'm just having it makes sense to hold infrastructure, for example. So you can argue in the REIT space, you don't want to own maybe apartments now, maybe, or you don't want to own office spaces, but you want to own infrastructure. You want to own Equinix. You want to own Public Storage. You want to own warehousing. There's been sub-niches in the REIT industry that we've been playing with for 20 years. I mean, the industry knows this, right? And you can actually have tactical asset allocation within the REIT industry.
Well, you're right. So you're mentioning tactical asset allocation. We're in surveying advisors, Bob, in the last couple of years, almost 2/3 of advisors have taken money off the table in the traditional 60-40. And what they're doing is looking for either stick it in cash, $6 trillion in money market funds these days, or they're buying alternative strategies. And in many cases, it's going towards active managers who've got a history of doing a good job in those areas, as opposed to individually buying indexes that happen to be thinly sliced. Well, you can make a case for base metals. There are great base metal ETFs that are out there, agriculture ETFs that are out there. However, you need to make the decision on that allocation. When things are tough, advisors love to turn to active managers, and we're seeing more of the flows going into those areas.
But it's more expensive. What are we charging for this?
65 basis points.
Yeah, so that's not 10 basis points.
Right. You know? It's not. At the same time, if you're an advisor and all you're doing is indexing, during those tough times and you look on your bench for help and managers, those indexes aren't going to provide that. So what we're doing now is we're seeing, hey, we've gone through some of these tough times. What's going to get us out of those? What does it look like a year from now as we've had rising interest rates? Where can you get good cash flow? That's real money that's coming in. That's really important. And then most importantly, where can you diversify that if we happen to see an equity pullback or as rates are rising and bonds still aren't making any money, where can you go to actually have some stability?
Interest rates, you mentioned interest rates. Let me ask you the 30,000-foot question. Interest rates are creeping up. Yeah. What, if any, impact is this going to have on the overall ETF market? Where do you see, we're not blowing out, but you see 1 and 2 year yields, they're trading towards the high end of their recent ranges.
Right.
People are a little concerned it might break out, and that could slow down the rally we've been seeing, the overall rally.
It absolutely can, but a couple things that we're seeing, you can see this by the flows. The average advisor today feels a year from now rates will be lower. So what they're doing is, although you're getting 5+% in money market funds or short-term treasuries, that's great. They don't think that's going to be available a year from now. So they're going longer duration. They're going into higher credit quality types of ETFs. They're using more active managers as well, with the idea that, I mean, it's tough to believe, but we're actually going to see appreciation in bonds once rates start going down. But that date of when rates will start declining keeps getting pushed out as inflation is still something that's not under control, right?
Dan, CBRE is a long history. I was the real estate correspondent for CNBC 30 years ago, more than 30 years ago. Yes, I am that old. Thank you for asking. I used to cover this is Coldwell Banker, you know, all those old companies that are out there. Is this your CBRE's first foray into ETFs? You've got a label here. I know you're partnering with Index IQ.
Yeah, we've partnered with Index IQ and New York Life Investments, who's our distribution partner. This is our first active ETF. We did launch a passive ETF roof last year. So that's dedicated specifically within the real estate space. So yes, relatively new, but we, again, think that there is an opportunity here because real assets in the ETF market are, you know, a pittance of where the capital is, right? Mostly still sitting in open-end mutual funds in the market. Again, as I noted, somewhat mixed return and risk profiles over time. So we think, one, you need to be active. There's an opportunity in the ETF market. And you need to be active because policy risks, you know, thinking about just real estate. Yes, there are risks. How can you avoid those risks and go after the right opportunities globally? And how do you think about infrastructure assets which do have a regulatory and policy dynamic that you have to understand, right? That's where you want institutional level expertise, and that's what we bring to the table.
Yeah. I want to ask a completely different question for you, Tom, because he's our overall ETF maven here. We have seen a spate of new Bitcoin ETF offerings recently, including from BlackRock. Even though everybody knows the SEC and Gary Gensler is completely hostile to the idea, and everybody said, well, they're going to say no to a Bitcoin ETF, just like they said no to everybody else. But I'm wondering why now? What does BlackRock think they're going to get out of this effort? You
can't get away from your favorite subject here, can you?
People ask me about it, and I don't have an easy answer for it. I always think I'm missing something here.
I think you're right. I think your sniffer
you think
usually
I'm missing
is
something?
No. I think you're onto something. I think your sniffer is always really pretty good, Bob. If BlackRock all of a sudden has filed for a Bitcoin ETF that's not futures based, it's spot Bitcoin, okay? And Gensler said, no way, that's not going to happen. But at the same time, they're bringing together some pretty good partners from a custody standpoint. They've got Bank of New York Mellon. They've got Coinbase.
Right.
They've got an agreement, a surveillance agreement with NASDAQ to help with the security aspect of it. So they're trying to show the SEC that they're putting all the safety provisions in place to give them the confidence, to give them that acceptance of their application. I think the big thing we know is Gensler said, we're not going to do anything there unless we have the exchanges regulated, and Coinbase is not regulated.
But that's my question. Do you think this is going to change their mind? I can't without the clear regulatory authority, and they're not getting a bill through Congress. So now he's just resorted to essentially suing everybody. He's trying to regulate essentially by filing complaints.
Yeah.
I don't see how this changes.
If anybody can get it done, would you bet against BlackRock?
No.
You know, they're the behemoth, right? They're the.
That's why I'm thinking. I still don't quite get.
Yeah.
I don't. How are they going to change his mind?
I mean, if they can partner with Coinbase and say, look, you agree to get regulated, what would that do to your business? Imagine institutional investments, just 1% allocation to Coinbase, and what that would mean. We're talking about a lot of money.
Yeah.
So there are a lot of people like you that are saying, huh, is this finally the time? Is it going to happen?
We're going to follow this very carefully, folks, because, again, they're not going to waste their time.
Yeah.
Trust me,
Yeah.
BlackRock isn't. If they don't think they have some chance
Sure.
of doing something here, we'll have him back and some other people back to talk about this. But the time's up, folks. It goes fast here. That does it for this week's ETF Edge. And my thanks to Dan and Tom. We've asked Tom to stick around and give us a broader perspective on ETF trends for the ETF Edge podcast. That's coming up right after the show. And remember, you can see all of our shows. It's on our website. It's always been there. etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.